pounds. So we have the pound US dollar has fallen to its lowest levels in just over 6 months. And if we look at the technical levels and the technical trends, we can very much see the head and shoulders pattern, which we spoke about last week. We've been speaking about this for a while in our analysis. That very much has been in play on the pound US dollar, the daily time frame. And since falling below this head and shoulders pattern, and specifically our neckline, which you should see on our screen here, we have seen a drop in the pound US dollar by close to 400 or so pips. We now have a very much of a bearish of a downtrend that's continuing on the daily time frame. And when it comes to potential levels in the pound US dollar, this appears to be very much a falling knife. It's a big risk to go for the pound US dollar, even though it appears oversold. One of the reasons for this is because of the downtrend that's continuing. If we look at our candlesticks here, we very much still have lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. And it looks like today's candlestick will be another one. That signals that the sellers remain in control of this asset. When it comes to a downtrend, more than 2 successive candlesticks of lower highs and lower lows, that does signal a downtrend, hence why the market is still on a technical basis looking like the pound US dollar has further room to move lower. If you to ask me possible levels that we should watch in the pound US dollar, what could be our support, where could be our resistance? Well, firstly, the market can clearly still potentially move even lower. Levels that I'm looking at in the pound, it would not surprise me if we see 122 this week. We might even see 120 before the end of this as we head into Q4 2023. Why is that? Is that because the market is so strong and so bullish on the US dollar, and the trend is your friend. And if the market continues to buy US dollars, every asset is going to remain sold against the US dollar, and the pound doesn't have buyers in the market. Essentially because of the economic problems, because of the inflation woes, and because of other concerns over UK financial market sentiment. One pair and pound cross that I am watching is the euro pound, which is teasing a breakout from 4-month highs. As we can see on the flip side from the downtrend we spoke about on the previous slide for the pound US dollar, we actually see an uptrend appearing on the euro pound. This is where we have successive candlesticks of higher lows and higher highs. Again, more than 2 candlesticks would signal an uptrend, and we're now pushing towards what we could say is quite stubborn resistance in this pair. Could it be a potential buying opportunity? Yes, from a technical perspective. However, we again have to consider and remember how weak sentiment for the euro is. It's like a tug of war. Euro dollar is being sold, the pound US dollar is being sold. So this breakout here that we're seeing and the uptrend is essentially because the pound US dollar fell so heavily over the last week. If we looked at the period before, we could say it was because the euro had fallen so heavily over previous trading weeks, which is our red candlesticks here. Speaking of the euro and the euro US dollar, we are still seeing that there's a high risk of the euro dollar falling to its lowest level since early March this year. And we can see that the downtrend since its peak on our candlestick here very much remains in play. Again, the candlesticks, we have successive Lower highs and lower lows, lower highs and lower lows. And this support level here looks like it's a potential going to break. We might even have the Eurodollar fall as low as 105 imminently. That's something we haven't seen in the pair for 6 months. The reason, again, is not just because of Euro concerns, it's because of relentless strength in the US dollar. The US economy continues to perform far better than its peers. Interest rate policy in the US is the envy. The US Federal Reserve is saying that they might raise interest rates because they can, because the economic data is handling it. Whereas on the other side of the coin, interest rates are being raised elsewhere because there's no choice. There's so much concerns over inflation pressures, which is why the market is so much selling currencies like the euro and the pound, because the European Central Bank and the Bank of England are needing to raise interest rates because they have to. The Federal Reserve in the US, it's different. They actually can, although inflation is still a concern. Away from the very consistent trends of selling the Eurodollar, selling the pound US dollar, one asset and assets that I'm going to be watching for specifically over the coming days are the Japanese yen. The Bank of Japan left interest rates unchanged last week, despite the unexpectedly upbeat comments made just 1 week prior. However, members of the Japanese government are now commenting on currency weakness. This shows that the highest levels of Japanese authorities are worried about how weak the yen is, which does raise questions about it being a matter of time before the Bank of Japan likely intervenes in financial markets to buy yen and sell US dollars, something they've been known to do in the past and the recent past. This week sees yen inflation data announced. That means there's going to be inflation data announced for the Japanese economy. Should we see any signs that might indicate from the inflation data that Bank of Japan will need to act before the end of this year, likely traders are going to have some encouragement to buy the Japanese currency, which is why we are looking at the following charts. Starting with the dollar yen on the daily time frame, we've seen that the candlestick today indicates that the Japanese yen is weakening to its weakest level since roughly October, November 2022. What's specific about this trend is that we are appearing very, very close to our orange box that you should see on my screen, which is where the Bank of Japan are thought to be acting in financial markets, which is roughly what started late last year, as we can see from the drastic red candlesticks, which is when yen intervention rumors first started to emerge. So, if I was looking at this pair, clearly we have the uptrend, higher highs, higher lows on the candlesticks. Definitely the trend is still bullish. However, from a fundamental perspective, we need to be concerned about the Bank of Japan and Japanese government, because they won't continue to let the yen weakness. So potentially there's an opportunity here on our red box to start entering some possible selling ideas on the dollar yen, which means that the Japanese yen should strengthen. However, that is only the case if authorities do intervene in financial markets. It's something that's been speculated, but it's not something that we've seen confirmed. But given the most recent comments from just days ago from members of the Japanese government, we cannot rule out this potential idea, which is why we might see a pullback in the dollar yen. At the moment, we see the uptrend very much remains in play. We should also remember that when it comes to Japanese yen pairs and the assets, it's not just the dollar yen we need to look for potential opportunities. We also have the pound yen and the euro yen. So we need to look at all Japanese yen crosses. And in fact, with the dollar yen being a risk because of how strong the dollar actually is across all global assets, should the Japanese yen strengthen because of Bank of Japan getting involved in the market or members of the Japanese government, it's more likely than not going to be the pound yen, which is the GBP JPY, and the euro yen, EUR JPY, which is where we're going to see the opportunities for a pullback. Because sentiment for those currencies, as we've just discovered in our Eurodollar and our pound dollar charts, is extremely weak. Our favorite metal, our precious metal gold. We pretty much remain in the same place as where we spoke about in our webinar last week. The gold upside very much appears limited to 1950. At the moment, we're trading somewhere around 1930. Why is the upside limited? Because the opportunities and the strength in the US dollar is so relentless. Until we get the signal that the dollar is going to weaken over the medium and the longer term, we essentially still see the trend being our friend that the market wants to remain very close to the US dollar, to the greenback. So we likely will not see gold appreciate above 1950 and once more up until the market wants to sell US dollars. And given the current technicals, given the dollar index, given the trends I've spoken about on the Eurodollar, the pound dollar, and so forth, that's unlikely to occur anytime soon. It's even doubtful that that might occur over the final quarter of 2023, which is in fact just over 1 week away. So what can we do with gold? Firstly, the quiet range is likely because traders want to keep hold of gold because of world inflation pressures and economic concerns. But essentially, for as long as the dollar remains in demand, the downside is more likely than the upside. It would not surprise me if we did see another challenge of $1,900 should and if the gold price continue to strengthen, the US dollar. One trend that we have seen come to somewhat of a pause is the exaggerated buying and the aggressive buying of US oil that has taken place over the past couple of weeks. As we see from our aggressive uptrend, the US oil price has expanded and appreciated by as much as $15 or more. Some still expect the uptrend to continue and that we might have $100 in oil before the end of 2023. What I would say to you on this point is we have to remember that the fundamentals and the technicals of oil are being very much ignored because it is political forces and geopolitics that's impacting and influencing the oil price, specifically production cuts from Saudi Arabia, OPEC, and OPEC Plus. So we might have some temptation to take profit on oil. I understand it. Certainly the uptrend was very much aggressive and the price should have a pullback from a technical perspective. But we cannot rule out that the politics around the oil are not only volatile, but they are unpredictable. Should the oil price come back below $90, hypothetically, or get towards $85, again, hypothetically, we cannot rule out the potential for a statement to come out from an oil producer saying that we will cut production even further, because oil producing nations such as Saudi Arabia, as an example, have a narrative and have a bias to keep oil prices as high as possible with government revenues. Even if this is the envy of all of our economies that we come from that have to import oil, including the likes of the pound and the euro, which is why I said last week that the stronger oil price provides a very much an opportunity to sell euro dollars and pound dollars. And thankfully, from a technical perspective as well from a fundamental perspective, we did see price action move in that direction. Our final chart and our final asset that we're going to watch out for today is actually Bitcoin. We've seen quite a turn in more selling momentum over the past session. We might be above $26,000 at this point, only by $70 or so if you look at where this chart was taken. But there are some concerns that Bitcoin might move back below $25,000. Despite the false breakdown we did have a couple of months ago, $25,000 in Bitcoin isn't something that we've seen specifically below since early 2023. I think it's possible that we are going to retrace and go back towards those levels. Not much because of a fundamental point of view, but just because sentiment for cryptocurrencies in this environment of such a strong dollar, inflation concerns and so forth, doesn't seem to be as strong and as resilient as it was a couple of months ago. But again, Bitcoin is a very risky asset, and it is an asset that can move in any and either direction at any given time. Okay, guys, do we have any questions on the assets and what we've just watched and covered over our week ahead webinar over the past 30 minutes or so? Okay, so just before we conclude, let's have a quick recap on what we're watching in markets this week. We're looking at some of the economic indicators. They might not be as much of a tier one as the central bank decisions from last week, but they're still important. We're still looking for further likely declines in assets like the pound US dollar and the euro US dollar, specifically because the US dollar very much becomes our friend. We are watching very closely for the Bank of Japan and how the Bank of Japan might act over the coming days, specifically when it comes to yen weakness. The technicals on the pound US dollar still signal that we're going to have further losses ahead. The euro pound actually indicates we might be teasing a breakout to the upside, but I would be somewhat cautious on this potential idea because of how weak sentiment to the euro is. Speaking of which, the euro remains very much stuck in its downtrend. We are at levels now close to what I haven't seen since the early part of 2023, very much the end of the first quarter. It would not surprise me either if we have further woes for the euro, like the British pound. Where we are looking for is for some maybe opportunities and volatility in Japanese yen and crosses, specifically the US dollar, Japanese yen, where the currency is now approaching the zone of intervention levels. But again, remember how strong the US dollar is against all of its different assets. The dollar yen might not be the only pair to watch. We need to look at the crosses, specifically the euro yen and the pound Japanese yen. Gold upside appears very much limited to 1950 still, the exact same as where we were at the beginning of last week. We can't say and be optimistic on our precious metal, on our best friend gold, until the US dollar shows a significant sign of weakness, and considering the ongoing and consistent strength for the greenback, that's unlikely to be the case anytime soon. Oil price might be indicating some pullback and a change in momentum, but again, be careful around potential political risks, specifically when it comes to production cut risks from our oil producing nations. And finally, we do have a setup where Bitcoin might be teasing a possible move below $25,000. Apart from a false breakdown a couple of months ago, we haven't seen below $25,000 in Bitcoin since the early months of 2023. Thank you very much for watching this webinar from GQC. We will see you again next week with our week ahead webinar. I wish you a successful week of trading. And please do not forget that this webinar was for educational purposes only. They were only my personal opinions on financial markets and were not to be taken as trading advice. Thank you very much for watching, guys, and I will see you again next week. Cheers.